Every market crash, no matter how unprecedented, traces the same familiar path. The Roaring 1920s, the dot-com frenzy, the 2008 collapse. Each began with easy money, runaway assets, and euphoria. Then, they fell into chaos and painful resets. The real story behind every financial disaster is not a secret. It is a 7-stage cycle, hidden in plain sight. But why do even experts ignore the signs until it is too late? If you can spot what comes first, you might see the next crisis before everyone else. Here is how that cycle really begins. Interest rates rarely make headlines, but they shape every boom and bust. In 2001, the Federal Reserve cut its main policy rate from 6.5% to just 1% by 2003. The move was meant to jolt the economy back to life after the dot-com crash and the shock of September 11th. Cheap credit became the new normal. Banks could borrow for next to nothing. Loans for homes, cars, and businesses multiplied. In closed-door meetings, some Federal Reserve officials worried that easy money might fuel risky bets, but the majority pressed on. Alan Greenspan, then Fed chair, insisted in 2004 that there was no evidence of a housing bubble. The official meeting minutes, released years later, show that a few voices like Governor Gramlich warned about loose lending standards, but their concerns were set aside in favor of growth. The cycle repeated after 2008. In the wake of the financial crisis, the Federal Reserve slashed rates to near zero and kept them there for years. This era, known as zero interest rate policy, began in December 2008. By 2010, the Federal Reserve also launched quantitative easing, buying up trillions in government bonds and mortgage securities. The goal was to keep borrowing costs low and encourage banks to lend. The effect was a cheap money tidal wave searching for a home. From Wall Street to Main Street, borrowing felt safe again. Mortgage rates hit record lows. Companies refinanced debt at rock-bottom costs. Investors, unable to earn much from savings accounts or bonds, started looking for higher returns elsewhere. On a chart, the federal funds rate looks like a steep slide from 6.5% in 2001 to 1% by 2003, and then down to nearly zero after 2008. These ultra-low rates didn't just rescue the economy from crisis. They laid the groundwork for the next chase and set the stage for money to flow into whatever assets promised the biggest gains. By 2021, the impact of cheap money was unmistakable in the world of crypto. The total market value of all cryptocurrencies exploded from about $18 billion in early 2016 to just under $3 trillion in November 2021. Bitcoin, once a fringe curiosity, became a household name. Ethereum, Dogecoin, and thousands of other tokens followed, each promising new technology or quick riches. Prices soared far beyond anything justified by real-world adoption or earnings. For many, it felt like the rules no longer applied. Retail investors piled in, drawn by stories of overnight millionaires. Social media platforms buzzed with charts and memes. On April 26, 2021, Elon Musk tweeted a picture of Dogecoin barking at the moon. Within hours, Dogecoin's price surged, fueled by online excitement and a few viral posts. In group chats and forums, newcomers swapped tips and bragged about gains. A 27-year-old retail trader posted on Reddit that you cannot lose with crypto. She said she borrowed against her car to buy more tokens, convinced that prices would only go up. Her story echoed across thousands of similar posts, each one a snapshot of the new mania. Financial analysts and influencers joined in, declaring a dawn of a new era. Headlines proclaimed that crypto is the future of money and that decentralized finance will end banks. The language was familiar to anyone who had watched the dot-com or housing booms. This time, the old limits did not matter. Data showed crypto prices rising dozens of times faster than incomes or economic output. The market capitalization of digital assets leapfrogged entire sectors of the real economy. For a while, it seemed like everyone wanted in, and few stopped to ask what would happen if the music stopped. In the late 1990s, the promise of the internet drew millions off the sidelines and into the stock market. One-day trader known on early message boards as Web Van Dad quit his steady job to trade tech stocks from his spare bedroom. He was not alone. Taxi drivers, teachers, and retirees opened online accounts, convinced that every dip was a buying opportunity. As the Nasdaq surged, talk of easy riches swept through coffee shops and dinner tables. The index rocketed from under 1,000 in 1995 to an astonishing 5,048 by March 2000. Magazine covers declared a new era. On television, analysts insisted that profits were old-fashioned and that clicks and eyeballs were the unedited numbers that mattered. Headlines blared, Dow, 36,000. Get there while you can. Margin debt soared as ordinary people borrowed against homes and credit cards to buy more shares. Pension funds shifted money into tech, eager not to be left behind. The language of caution vanished. In chat rooms, any voice of doubt was drowned out by stories of six-figure wins. At first, it was easy money. Then, in 3 days, everything was gone, Webb Van Dad later recalled. In that moment, the only thing that seemed to matter was the next big score. Media personalities and best-selling books promised that the rules had changed forever. "This time is different," became the rallying cry. The euphoria was not limited to stocks. Real estate seminars filled hotel ballrooms. Crypto forums decades later would echo the same optimism. The cycle was always the same. When everyone believed the gains would never end, risk and caution faded into the background. Leverage, borrowing to buy more of the hot asset, became a badge of confidence. As prices climbed, so did the bets. The feeling in the air was unmistakable. Tomorrow would always bring higher highs. At 6 a.m. on March 14, 2008, the phones at Bear Stearns' treasury desk rang with bad news. Overnight lenders, spooked by swirling rumors, refused to roll their usual billions in short-term funding. By sunrise, the firm's cash cushion was vanishing. Bear's Chief Financial Officer Sam Molinaro and Chief Executive Officer Alan Schwartz scrambled to find replacements for the missing money. They called every major bank and money market fund they could reach. Most responded with silence or a flat no. The sense of routine vanished as the scale of the pullback became clear. Inside Bear's headquarters, an executive dialed a longtime counterparty. The line rang and rang. Later, he recalled that he knew the firm was done when overnight lenders did not answer the phone. In hours, the company went from business as usual to an existential crisis. By 8 a.m., Bear's treasurer warned the executive team that the firm needed billions immediately, or it would miss payments when markets opened. On Wall Street, word spread fast. Bear Stearns' stock collapsed in pre-market trading, dropping over 40% before the opening bell. The VIX, Wall Street's fear gauge, spiked sharply as traders braced for chaos. At 9 a.m., Federal Reserve officials convened an emergency call with the Treasury and J.P. Morgan Chase. Bear Stearns, a storied investment bank with 85 years of history, was now begging for access to the Federal Reserve discount window, a backstop never before used by an investment bank. By 11 a.m., Bear's cash was nearly gone. Counterparties demanded more collateral or stop trading altogether. Funding outflows topped $13 billion, almost wiping out the firm's available cash. In a last-ditch move, the Federal Reserve and J.P. Morgan agreed to a $12.9 billion bridge loan. Bear Stearns issued a public statement claiming it had secured liquidity. But inside, staff knew the damage was done. The stock closed the day down 47%. For insiders, the turning point was not a headline or a formal default. It was the moment the phones went quiet and trust disappeared, revealing how quickly confidence, not just capital, can vanish from the system. On September 15, 2008, Lehman Brothers filed for bankruptcy. Overnight, the world's financial systems seized up. Credit markets froze as banks stopped trusting each other. The TED spread, a measure of fear between banks, spiked from 40 to over 450 basis points in a matter of days. Margin calls hit investors with no warning. Those who had borrowed to buy stocks or real estate had to sell, no matter the price. The Dow Jones plunged by 25% in a matter of weeks, echoing the panic of 1929 when forced selling and margin calls wiped out fortunes almost overnight. A historian of the Great Depression described the moment simply: borrowed money can multiply losses faster than anyone expects. The pain quickly spread beyond Wall Street. By the end of 2009, U.S. unemployment reached 10%. Factories shut down. In towns across the country, families gathered around kitchen tables, staring at layoff notices and past due bills. One auto worker in Ohio described the day he lost his job. "It wasn't just me, my whole line was gone by lunch." Bankruptcies spiked as companies ran out of cash. The so-called wealth effect flipped. Households slashed spending, deepening the downturn. Panic selling and credit withdrawal did not just erase numbers on a screen, they upended lives. The pressure for government action became impossible to ignore. Congress approved the $700 billion Troubled Asset Relief Program called TARP on October 3, 2008. The vote followed days of market chaos and a rare televised plea from Treasury Secretary Henry Paulson. Banks received direct capital injections, and the government took on toxic assets that private investors no longer wanted. At the same time, the Federal Reserve launched its first round of quantitative easing, buying up hundreds of billions in government bonds and mortgage-backed securities. Fed Chair Ben Bernanke explained, "We learned from the Great Depression that doing nothing is the worst option." The crisis response was massive, fast, and controversial. Sheila Bair, then head of the FDIC, later reflected, "TARP was a wrenching decision, needed to save the system, but it was not without consequence." Many banks and insurers survived only because of these extraordinary measures. Some, like Lehman Brothers and Washington Mutual, vanished. Others limped along, propped up by cheap credit and government support. By 2023, nearly 12% of U.S. public companies were classified as zombie firms, businesses that could not pay even the interest on their debts without new borrowing. The rescue stopped the bleeding, but it also kept weak players alive and set up new risks for the next cycle. Promises of reform and stronger rules echoed through Congress and the media. Yet the memory of near collapse faded faster than anyone expected. After the storm of bailouts and emergency lending, the economy enters quieter territory. Debts that once fueled the boom now weigh heavily on households, companies, and governments. Some loans are restructured. Others are written down or quietly defaulted. Distressed assets, foreclosed homes, bankrupt businesses, portfolios of bad loans change hands at steep discounts. In the years after 2009, private equity firms and large investors scoured auction lists. They bought up entire neighborhoods and shuttered factories for pennies on the dollar. These buyers often wait, knowing that when recovery comes, prices will rise again. For many, the pain of the bust lingers. Unemployment remains high, and wages take time to recover. Yet slowly new businesses start up. Entrepreneurs spot opportunities in the wreckage. They launch companies that learn from past mistakes or use new technology to solve old problems. The balance sheets of banks and families gradually improve as bad debts are cleared away or inflated down by rising prices. Over time, the memory of panic fades. Carmen Reinhart has observed that each generation convinces itself the lessons of the last crash no longer apply. The cycle resets quietly, often unnoticed, until easy money and optimism return in a different form. The groundwork for the next boom is laid not by bold headlines, but by the slow, steady process of repair and forgetting. 9 warning signs have stood out in every major boom and bust cycle. First, watch for rapid credit growth outpacing the economy. When the credit to gross domestic product gap widens, financial systems become more fragile. Second, watch margin debt. If borrowing to buy stocks or other assets is surging, risk is building beneath the surface. Third, compare asset prices to real incomes or earnings. When home prices or stock valuations break away from what people actually earn, bubbles may be forming. Fourth, the TED spread can jump sharply before a crisis. That is a clear signal that trust is breaking down in the banking system. Fifth, rising non-performing loans at banks show that more borrowers are falling behind. This often happens just before trouble hits. Sixth, rising corporate debt relative to earnings makes companies vulnerable. Even a small downturn can force cutbacks and defaults. Seventh, the household debt service ratio matters. High ratios mean families are exposed to shocks because more income goes to debt payments. Eighth, look for excessive lending, even after adjusting for inflation. Rapid loan growth can hide problems until it is too late. Finally, spikes in the VIX, Wall Street's volatility index, often come just before or during sharp market sell-offs. Each of these indicators is tracked by central banks and financial regulators worldwide. Learn to spot them early, and you will recognize trouble long before headlines declare a crisis. Context, not a forecast. Global debt now stands at more than 330% of world GDP, the highest level ever recorded. Central banks have pushed policy rates up to around 5.5% in 2024, ending more than a decade of ultra-cheap money. In some markets, asset prices, especially in technology stocks and selected real estate, remain well above long-term averages, even as growth slows. Pockets of risk are visible. Zombie companies, firms that cannot cover interest payments from earnings, make up a significant share of public companies. Stress signals like the TED spread and market volatility have flared at times, but they have not reached the extremes seen in past crises. These conditions resemble the late stages of previous cycles, but the exact timing of any downturn is impossible to predict. Claudio Borio of the Bank for International Settlements says that early warning indicators like rapid credit growth and surging asset prices warrant caution, but timing is unknowable. The checklist of signals remains useful. It is not a crystal ball. Today, global debt exceeds $300 trillion, and asset prices in many sectors remain near historic highs. As policymakers debate how much risk is truly behind the numbers, every new boom quietly sows the seeds for the next bust. The cycle endures, not because we forget, but because we believe, each time, that this time is different. The pattern remains. Awareness is the first defense.